So now we'll be on our best behavior because we're being
That's right.
recorded now.
Yes, I'm Jill Brosser. I'm a Winnetka Library Reference Librarian, and I'm also one of the program bookers. And I guess I'll introduce you. This is Ed Gjertsen, a local financial planner. He's a resident of Winnetka, and he's here to do this program called 10 Questions You Need to Ask Your Financial Advisor.
Excellent. Thank you. Thank you so much, Jill.
You're welcome.
So 10:04, 10:05, I will start the presentation. I've had outreach from a couple of people who are on this call in terms of recording it. So as Jill mentioned, we're recording this session. So hopefully we'll be able to post this and have it be able to be replayed to share amongst friends and family. And then also to help with this question, I will provide Jill a copy of the slide presentation to be able to get access to. So we'll figure out a way of you reaching out to Jill to get this as well, because some of the print later on in the presentation is a little small and there's a lot of it, but just so all of you know, the presentation will be available in a PDF format for all of you. So first and foremost, I want to thank all of you for spending some time today. From a practical perspective, the important part of my working with the library is financial literacy outreach. It's critically important to me. I've been working with local area libraries for over 15 years, working very closely with not only local libraries, but the Chicago Federal Reserve in terms of their Money Smart Week, and also in a bunch of different areas in regards to just connecting financial ideas and financial concepts in non-financial speak to individuals. I start every presentation nearly the same, which is an ode to Dr. Frank. Dr. Frank was a client of mine, and we were about 40 years apart. And over the years, we became very, very close. And he taught me a lot of things about life and aging. But the one thing he taught me is, I remember coming back from one of my association meetings, and I was just lamenting to him about the presentations, and they weren't very good. And I knew all the information. And in his very gentle 6'4" giant hands sort of way, put his arm around me and said, Ed, he goes, you don't know everything. And I'm like, okay. And he goes, when you're in a presentation, when you all of a sudden figure out, well, I know all these things, your brain kind of turns off. Instead, just try to approach it from a newness perspective. And so I remember being at a presentation and listening to the speakers, just first opening comments, and it almost sounded like nails on a chalkboard. And the topic I kind of knew, and literally I stood up and was getting to walk out. And I remember Dr. Frank's wisdom, sat back down and just, okay, off we go. I literally took 2 pages of notes. That was a transformative moment in terms of not only when I'm attending presentations, but also giving presentations. And what it boils down to is just nuggets, golden nuggets. If after the end of this presentation, if I've told you everything and you've known everything I've talked about, the positive of that is it's reinforcing what you've already known. Also, if there's things within this presentation that you're like, that's something that I didn't know, whether it's 1, 2, or 3 of those different elements, I've done my job in regards to guiding you to a place where you're now more informed. So I owe Dr. Frank a lot in regards to, again, not only how I attend presentations, but also how I give presentations. So this is 10 questions to ask your financial advisor. Why do we put this presentation on? Because it has to deal with your current and future financial well-being. There was some research done in regards to Americans and the cost of advice. And the analysis is that bad advice potentially costs Americans $17 billion per year. I think it's potentially much more than that because it's difficult to ascertain if the relationship is working or not working. There can be a product or a solution that you were sold that's okay, but may not have been in your best interest. And it's difficult to judge that. But again, this is an important topic in regards to your financial well-being, not only today, but also in the future. So normally in these presentations, and as I talked to Jill about this, I don't spend too much time talking about me because it's not about me, it's about the topic. But because of the weightiness of this topic, I just want to make sure that the audience members understand that the information that I'm sharing with you is coming from nearly 30 years of experience. So I've been in the industry. I've been on both sides. I've been taking commissions and fees. I've been an insurance licensee. I've been walking the halls of Congress, fighting and advocating for clients and individuals in terms of their rights. I've been a national past president of the Financial Planning Association, which is comprised of 24,000 certified financial planners. And I was the past president in Illinois, which is one of the largest chapters in the country. I've sat in Finra arbitrations. Finra is a regulator where a client has a grievance against a broker, and I've listened to the arguments. And as I mentioned, I've done a lot of advocacy work, not only in Washington, D.C., but across the country. But recently, I founded Engage Wealth Group, which is a fee-only financial advisory firm. And so this presentation is not about what's better, commission versus fee. It's again, just to kind of give you the information necessary for you to kind of understand what your relationship is with that professional and what you need to know. So the presentation we're going to break down into 6 basic steps. The first thing we're going to talk about is commission versus fee. Basically, how does the advisor or the professional get paid? Then we're going to talk about the goals, the importance of goals and advice. We're going to also review, where do individuals find an advisor? We're going to get into the 10 questions. We're going to, again, revisit commission, fees, insurance, and investing. And then we're going to wrap up and provide some resources for you. So let's get started. So as I mentioned earlier, this is not necessarily a judgment on what's better, commission or fee, but compensation does matter in our industry. Product sales versus advice. How an advisor gets paid, how a professional gets paid is all predicated on whether they're selling you something or they're just basically giving you advice. And then we're going to talk about advisor versus advisor and why one vowel really matters. So why does compensation matter? When you seek the guidance or the advice of a professional, if the individual is earning a commission, the only way that they get that commission is by selling you a product. Now, that's typically done with either insurance or securities. So you buy an annuity, you buy a long-term care policy, you buy a mutual fund that has a commission with it, or a stock that has a commission. The thing to remember, that that person does not get paid unless they sell you something. There's what's known as indirect payments. A commission is an indirect payment. You're not paying the advisor. You pay the insurance company a check for, let's say, an annuity, and then that insurance company then pays that insurance agent. Or if you buy a mutual fund that has a commission with it, when you write that check to the company that you're basically investing in, they pay that broker a commission. So that indirect payment creates not necessarily a transparent transaction, it's very opaque. And as for you as an individual, it'd be very difficult to kind of understand how much and who is getting paid. Conversely, on the fee side, you're paying for advice and you're paying for ongoing advice. And AUM is assets under management. So you entrust the advisor to manage your portfolio for a fee. And so that's assets under management. You can also have a relationship where you're paying an advisor a fee and it's a flat fee, whether it's for a one-time, let's say, financial plan, and then also hourly, where you just need a couple hours worth of work because you've got a lot of your financial house in order and you just pay them on an hourly basis. That's a direct payment. You're paying that advisor directly. And so from that standpoint, it's not going through a third-party intermediary. That money's going directly to the advisor, which makes it very transparent. And again, that's sort of the important difference between commission and fee. If at any time you have a question, post it into the chat. There should be a chat button in there, and Jill can read it and hopefully interrupt me if there's a question. And if not, if the question may take too lengthy of an answer, we'll put that off towards the end. We should have done that housekeeping in the very beginning. So let's talk about whom can take commissions. An advisor or an insurance agent are the recipients of commissions. Why this is really important is the legal obligation between that advisor or agent or advisor from a fee standpoint, between you and that person, has only to do with how they're being compensated. So if the individual is being compensated by commission, they're under what's known as the suitability standard, which is just, how old are you? How much income do you have coming in? How long have you been investing, or how long have you been involved in, let's say, annuities or insurance or the stock market? What kind of risk level do you have? And there's no duty of loyalty, which means that once the sale is made, they don't really need to follow up with you. Recently, regulators have put in what's known as Reg BI, or regulation best interest. And while that's an improvement over suitability, it's nowhere near the fiduciary standard. Where the fiduciary standard comes in is if the professional that you're dealing with is accepting a fee. They are an advisor. They need to disclose all conflicts of interest and mitigate those conflicts as best as they can. They have a duty of care and loyalty, which means not only of the initial working with them, but also an ongoing duty. And they need to keep best interest at all times. Now, one of the things, and we'll talk about this a little bit later, you can see that the Reg BI, or regulations best interest, that is in the commission column, as well as the best interest column, or best interest is also in the fee column. Basically, the regulators have stolen, in my humble opinion, that name. And those differences between the best interest on Reg BI and best interest on fiduciary is still very, very wide. So we don't want you to be confused by that, but that, I think, is the unintentional outcome of increased regulation. So let's talk about a vowel. You can see here that under advisor is OR, and under advisor is ER. That O versus E makes all the difference in the world in terms of someone's legal obligation to you. An advisor is someone who's either under suitability or Reg BI, which again is a lower standard than that of fiduciary. Someone who's taking commission cannot use the word advisor with an E. Only those who are taking fees, who are held to a fiduciary duty, can call themselves an advisor with an E. So that simple one vowel makes all the difference in the world in terms of what that legal obligation is between you and the person you're dealing with. So over the past couple of years, I've been working very closely with the Better Business Bureau of Chicago and Northern Illinois, and I helped them create Your Money and Advice e-booklet. And that e-booklet is designed similar to this presentation as outreach to help educate and guide individuals in terms of working with different types of advisors, professionals, in terms of dealing with their financial life. And that e-booklet covers a number of different topics and has direct guidance and ideas in terms of how to talk to a professional, where to go for information, and where to go for resources. But today's presentation is just going to focus on two areas, which is investments and insurance or risk management. So typically, what's really important, and I think basically a lot of individuals have this backwards. Most of the time, what individuals lead with is, how much money am I going to be making on an investment, or what's the rate of return, or what's the interest rate, or how much am I going to be receiving in dividends? And in my opinion, that's sort of backwards, because all of us have financial goals in one way or the other. There's a lot of different reasons why we engage with a financial professional. And so that can be anything from retirement to investment advice, debt repayment, insurance, risk management, tax, estate planning. There's a lot of different reasons why we decide to go seek some outside help. And so this is where I think, again, we have things backwards. The goals that you have are going to lead what happens with the portfolio or any product that you buy. So what I mean by that is, your goals are not necessarily completely or absolutely supported by what a rate of return is on the market. You need to decide what those goals are first and foremost, and then how your assets and how your resources can support those goals. So it sounds kind of nuanced, but it's really important that you lead with goals first. Invariably, and many of you on this presentation may have found this, when you go talk to an investment professional or an insurance agent, one of the first things that they start with is, wow, here's a new product, and here's the historical rate of returns, or here's a high interest rate, and boy, can this help your financial future, rather than starting with, hey, what are your goals? What is this money designed to accomplish? What are you trying to achieve? And then figuring out what the solution may be. So oftentimes those individuals present a solution first to help shoehorn those goals into it. So as I mentioned, I've been doing this for a pretty long time, and I love history and market history, economic history. And so once upon a time in our profession, in the investment profession and financial services profession, there were basically three distinct, buckets, if you would, in terms of professionals: an insurance broker, a stockbroker, and an investment advisor. So back in the day, these three folks stayed completely in their lane, right? You didn't have insurance agents giving investment advice or selling stocks. You didn't have stockbrokers selling insurance or giving investment advice. And so their compensation was really understood. If I'm going to an insurance agent, they're going to get commission. If I'm going to a stockbroker, they're going to charge me a commission for a stock, a bond, or a mutual fund. An investment advisor, they're just going to charge me a fee. So back in the day, this was very easily understood in terms of whom you're dealing with and how you're going to engage with them. So for instance, if you walk into a car lot, right, years ago, you knew definitively your antenna was up, someone's going to try to sell you on something. And this isn't disparaging against the car industry. It's just a matter of fact that certain professions have a historical, let's say, norm in terms of how they interact with individuals. Well, you look at how that industry has transformed today with companies like CarMax and others that have reduced that worry, that concern that you're going to have to go into this hard negotiation. So back in the day, things were really simple in terms of, oh, I know I'm dealing with an insurance person, I know I'm dealing with a stockbroker, and I know I'm dealing with an investment advisor. Today, that landscape has changed dramatically. And so while, let me get my fancy little highlighter here. So while you still have insurance people that just do insurance and you advisors who would just have fee, it's that stockbroker that has changed dramatically in terms of creating, in my mind, confusion for the client and for the individual. And so you might have an individual who sells insurance, also does fees, and also does commission. And so that kind of muddies the water in terms of understanding and realizing what kind of engagement do you have with that professional. So that individual who's in that middle column now can get commission and fees. Not only that, but they can be moving between different regulatory guidelines in terms of what their legal obligation is to you between Reg BI, fiduciary, or suitability. They can literally change hats depending on what product they sell you. And again, it's product sales versus advice. If it's a commission that they're receiving, it's product sales. So again, they don't get paid unless they sell you a product, vis-a-vis that of advice where you're paying someone a fee for that ongoing advice. So this is where a lot of the confusion has been created in the financial industry because those folks in the middle, those stockbrokers, have decided that they can get a bigger piece of the pie in terms of investments and compensation by trying to be all things to all people. So not only that, as we had talked about, insurance broker, stockbroker, investment advisor. I'm sure a lot of you are familiar with many of the titles that are up on the screen now, because you're not just an insurance agent or an insurance broker. People used to take pride in the fact that they're an insurance broker or a stockbroker or an investment advisor. And because of all the geniuses in the marketing departments, people have come up with a whole slew of different titles and different names, again, to try to make themselves stand out, but again, often causes confusion. One of the items I would really like to highlight is this wealth manager stars. So you might be familiar and you may see this where there's a company out there that gives advisors a certain number of stars. They're a 4-star or 5-star advisor. I want to be careful about what I say. And so years ago, I was contacted by this organization and they said, "Hey, Ed, congratulations. You are now one of our star advisors." And I'm like, "Wow, that's really great. Why did you pick me?" And so they went through a whole criteria. And one of the criteria that they shared is, "Hey, we talked to some of your clients and they told us you're a really good advisor." And I'm like, wow, that's great. How did you know who my clients were? So from my standpoint, when I really started to dig down in terms of that accolade that I was going to achieve or that I was going to be given, there was no way I would be putting that in my information because the vetting of that I did not think was very thorough. It was more of a marketing scheme than it was a vetting opportunity for individuals. So just because someone has a fancy title or stars after their name, just don't take it for granted that they know what they're doing. Understand that has more to do with marketing than it has to do with the material obligation, if you would, between the relationship between you and the advisor. Next. So this is the fun part. Where do individuals find an advisor? First and foremost, it's friends and family. You talk to family members, you talk to friends. Who do you use? What do they do? And typically, and this is the interesting part, wow, this advisor has made me a lot of money. And whether it's in the stock market or other areas or whatever it is, that tends to be the draw in regards to, wow, if they make them a lot of money, they can make me a lot of money. Second is work colleagues. You're interworking with different people. Again, you talk to different people within the company and otherwise, and they have a whole realm of referrals. And then there's professional referrals. So if you're seeking somebody to help you with financial advice, you may talk to your accountant or attorney or someone else in terms of referrals. Then there's the internet search, which those on the call who know this, it's almost like flipping through a phone book and figuring out, okay, whom should I choose and whom should I vet and so on and so forth. The other is the media. You may have read, seen, heard individuals or companies, whether it's advertising or even something like this, and you're like, wow, that individual makes a lot of sense and I understand that. But it's important to realize that some of the things that you may see are what's known as paid advertising, which I recall that there's a firm where on a Sunday morning they had bought airtime on a local station. And I remember listening and watching their presentation on the show, and I shuddered because it didn't take me very long to figure out what and how they were doing. And we'll talk about that story a little bit later. But ultimately, again, when you hear, read, see things in the media, again, it gives us exposure, but it doesn't necessarily mean that person has been thoroughly vetted. Last but not least, free dinners or lunches. Now, again, there may be some on this presentation who have been offered a free lunch or a free dinner at a fancy restaurant or a different kind of venue. You've gone, you've heard sort of a presentation about economics or Social Security or Medicare, you get a free meal, and then invariably you get the calls to set up an appointment and the pressure to set up an appointment. So of all of these different groups, the one golden nugget I'm going to give you is please, please, please do not. Nope. Oh, wait, it's such a fancy thing. Come on. There we go. Do not go to a free lunch and dinner and expect it to be free because it's not. There will be a lot of pressure that comes upon you for the sale of a product. And on the insurance industry and the insurance side, this is one of the more popular ways of folks who are selling annuities to ensnare you into their product. And again, remember, they don't get paid unless they sell you a product. And so if you've got 30 people at a dinner, they need to sell 2 or 3 different types. They just need to have 2 or 3 sales to pay for that whole dinner. So remember, if you're out looking for an advisor, in directly, one of the least ways, the least effective way of doing that is through a free lunch or a free dinner. So whether you have an advisor or you're looking for an advisor, I'm always of the ilk to trust but verify. So while you've been getting good referrals from friends and family or work colleagues or otherwise, if you're dealing with somebody who is selling commission and they're in the securities business, one of the best ways to go check their background is through what's known as broker check through a regulatory body called Finra. And again, we're going to be sharing these slides so you don't have to write these down. And so if you put the name of the individual or the firm name, there's a report that will show you if that person has ever run afoul of regulators. It'll show you their work history. It'll show you all the different details and historical background of where that person worked, in what industry they've been in, and what securities license they have. If you're working with an advisor that's a fee advisor, so that's an ER, right, investment advisor, you can go on the Securities and Exchange website and you can do the same thing. You can put their name in and they'll give you a report that'll show, have they ever run afoul of regulators? And they'll give you a lot more detail in terms of the history of the advisor as well. The least helpful place online to vet an individual is in the insurance industry. And I don't want to say that this is by design, but it is very difficult to know and understand if an insurance agent has run afoul of the insurance regulators. It's basically convoluted, and it's not easy. It's not easy to figure out if that person, again, has either run afoul or how long they've had their licenses and so on and so forth. Of all the three, that's the most murkiest in regards to figuring out if that person is truly an upstanding professional. So I provided details within these slides, which again we'll share, in terms of just step-by-step directions on whether you're going to broker check the SEC's website or trying to vet an insurance agent, which again is relatively straightforward, but tends to be a little bit confusing. So again, whether it's you're currently working with an advisor and you just want to trust but verify, or whether you're seeking to vet a new advisor, these are the tools and the opportunities to go in and look and see what that person's history is, and again, whether they've run afoul of any of the rules within the different industry segments. So 10 questions. What we're about to go through is completely appropriate. And what I mean by that is your ability to ask these questions are not out of bounds. You're not asking an individual for their tax returns or anything else or anything really personal about them. Remember that this is a business relationship. And so even though that advisor is potentially telling you they're working on your behalf, you want to make sure that these questions get answered directly. So by asking these questions, again, know that they're completely appropriate in regards to how you're vetting the professional. Be confident. This is one of the areas that oftentimes I feel because of the fact that you don't have, let's say, the industry knowledge that I do, you hesitate to ask these questions. Oftentimes in meetings, especially when I'm working with people who are new to the firm or are looking to vet us, when individuals stop and they smile and they nod, what that tells me is I have a question, but I don't want to ask you because I'm going to feel like it's a dumb question. And so I literally will stop wherever I'm at and reinforce or ask, okay, so do you have an additional question? That's incredibly important because the more questions you ask will help you get a better idea in terms of how that relationship will start and how it will continue. If you're not getting straight answers, then you need to be very wary. Trust your gut. Trust your gut that if you're talking to an individual, that if you're being shown glossy brochures and great rates of return, let's say historically, or they're skimming around answers, that is not the individual you want to work with. You need to get straight answers in regards to the questions that you're asking. And don't forget, if someone is lying, cheating, or stealing, they're not going to tell you we're lying, cheating, or stealing, right? They're pretty good in terms of the salesmanship, if you would, of the relationship. So always understand that when you're sitting across the table from somebody, whether it's a new relationship or existing, they're trying to put their best foot forward. So again, if you're not getting straight answers, realize why you're not and keep digging and keep asking more questions. Critical part, this is your money. This is your life savings. Do not take that for granted. So one of the main reasons behind this presentation is to help provide you with the tools necessary to make sure that you are protecting your life savings in regards to the professionals that you're dealing with. So my first number one question is, are you a fiduciary? And in regards to being a fiduciary, are you legally obligated to uphold the fiduciary standard? In the investment profession, the fiduciary standard is the highest standard in terms of working with clients, that it has to be in your sole interest, or your best interest. I like to use sole because, as I mentioned earlier, I feel like that word has been sort of taken for another element. So in your sole interest, conflicts of interest need to be resolved, meaning that if I have a relationship that I get enriched in another area, I have to tell you that. And then I have to try to mitigate that as best as possible. So the fiduciary standard is the highest standard. And the second question is, if they say, yes, I'm a fiduciary, great. Are you obligated to be a fiduciary at all times or just one time? And I won't spend a lot of time getting muddied in the waters on this, but there are relationships where I just have to be a fiduciary once only. And then from then on, I can kind of do whatever I want to do in regards to selling new product and services. So from your standpoint, it's up to you to decide what kind of relationship you're looking for. In that fiduciary standard, that fiduciary obligation, you want that individual, if that's what you're seeking, is to be a fiduciary at all times. And I had mentioned, beware of the word best interest. As I had mentioned earlier, the folks on the commission side, Finra and the securities regulation have borrowed that word under regulation BI or regulation best interest. So when you hear an advisor say, of course I have your best interest at heart, that does not mean that they're a fiduciary. So that is why we lead with that question. So what services do you offer? So when we engage, are you going to earn a commission or are you going to earn a fee? Is it sales or advice? And again, if it's a sales relationship, you just need to understand that while that person may be giving you guidance, they don't get paid until you buy something from them. Whereas if it's a fee advisor or fee only advisor, you pay them a fee and that's ongoing advice. So they're not needing to sell you over and over and over again. So what products and services do you sell? And this is really important. Do you offer products from just one company or for several companies? And in the insurance world, this is where it gets really important. So if all I have is a hammer, the whole world looks like a nail. So invariably, if I can only sell one company's product, you're going to bet that the only solution you're going to get is from that one company. Whether that's the right product or the best product for you is irrelevant because the only thing that I can sell you is that one product. Are you going to be offering me commission-based mutual funds or stock accounts? So I'm looking for an investment professional to handle my portfolio. And is this a commission relationship? And do you make more money the more buying and selling you do, or on the mutual fund side? And again, it's just so you have a good understanding of what that relationship will hold. When we talk about multiple discipline professionals, will you be offering me annuities and long-term care or life insurance as well? Or are you giving me just straight financial advice or financial planning for a fee? These are all the things that you want to understand, which again, going back to the goals question, is so critically important. You know where you're at today, you know where you want to go tomorrow, and what vehicle or what product or what service is going to help you get there. And this is why it's important to kind of vet through these information. So what experience do you have working with clients like me? And so one of the things that is important is if you happen to be the CEO of a major corporation and yet the advisor doesn't have any clients like that, I don't think you want to be the first test run with that client. Conversely, if you're a family with young kids and you're planning for college and potentially retirement, you want to ensure that that advisor has experience working with those individuals. Most of the folks in our profession like to deal with retirees. And directly, the reason is for that is because there's a lot of money in motion. And what I mean for that is when someone comes upon retirement, they're looking at potentially rolling over a 401k, or they're moving a lot of monies in different places, setting themselves up for retirement. And this is why our profession likes to focus on retirees, because you've done the wealth creation, you've built up your money, and that gives that advisor, that insurance person, plenty of opportunity to make money one way or the other. How long have you worked with your current firm, and when did you leave your last firm? One of the things that I have found is if I have seen advisors jump from firm to firm to firm, there's something not right in that relationship. And this is where those reports come in from the regulators are so important, because it gives you a detailed work history in basically a historical timeline in terms of what firm they were with and how long they've been with the firm. And again, if you see an advisor in the past or a broker jumping from firm to firm to firm, it's not that you don't want to work with them. Just understand that there's probably a good reason while they're jumping from firm to firm. So stability in their work history is a good reflection of their track record. That if I'm a firm and I hire an advisor and I want them and they're good at what they do, I want them to be around for a while because they're serving the client well. So again, we talked about working for multiple firms over a short period of time is a yellow flag, not a red flag, but it's a question of, boy, why have you moved from firm to firm to firm? Understanding you're not going to get the answer, well, I'm not really good at what I do and I've been selling people a bunch of stuff they didn't need. That's not the answer they're going to give you. So again, understand that when you ask a question, you're going to get an answer back that may not necessarily be fully transparent. So what qualifications do you have? We in our industry are not allowed to take compensation for a client unless we have licenses. And those licenses are typically given by the Securities and Exchange Commission or Finra. And Finra, again, is the regulatory body. So if I am selling you commission in a securities level, I either have a Series 6 or a Series 7, which means that I took a couple of tests to make sure that at least I have basic knowledge in regards to handling your finances. It doesn't mean I have the depth and experience. It just means I'm allowed to now take commission from you. So also the insurance license of all the tests I've taken, and I showed you all the exams and all the licenses I had, the one that was most stressful to me, which is counterintuitive, was the insurance license, because everyone that I talked to said it's the easiest license to pass. And for that, you get a little bit of anxiety. You're like, oh my gosh, if it's that easy and I fail it, I'm just going to be, I'll look kind of silly. It was a very easy test to pass. And again, with all due respect to the insurance industry, that threshold bar is pretty low in terms of just what questions you ask and what answers you need to give. If I'm taking fees and I'm an advisor, an investment advisor, I need to have what's known as a Series 65 or 66. So again, when you're going through these regulatory reports, you'll see exactly what licenses these individuals have. Also, what designations do you have? Our industry tends to gravitate towards designations, again, to differentiate ourselves from all of our competitors. The ones that the regulators acknowledge are the CFP, CFA, CHFC, and then you've got CPAs, and they're not necessarily licenses, but JDs and the others from that standpoint. So what you're looking for is that if there's a 3-letter sort of acronym at the end of someone's name, you want to make sure that that is a thoroughly vetted acronym, thoroughly vetted designation. Do you have any disciplinary history? And this is what I would suggest you do. Again, whether you're seeking or vetting a new advisor or your current advisor, I would ask this question after you download the report from the regulators. And that's where the trust but verify comes in. So what I mean by that is, say you want to go out and you want to research and you want to vet an advisor. You'll get their name and information first. You'll go to the regulators' websites, the ones that I've outlined, and you'll pull their report down and you'll read that report prior to the meeting. And so during the meeting, you can ask them a very simple question. Do you have, or your firm have, a disciplinary history? And if they say no, and that report says yes, thank you very much for your time. You get up and walk out. It's that simple from that standpoint. Also, just because someone does have something on their disciplinary history doesn't mean immediately you kick them out the door. It's just another opportunity to ask further questions, because I've seen things on advisors' reports that were inane. There was one report where, the way that I read it, I think someone tried to use a fake ID to get into a bar, which in today's environment, post 9/11, is not a good thing. And that's on their permanent record. It doesn't mean that person's a bad person. It just means they made a bad decision back in their college days. Also, in my experience, what I've seen is, if those in the industry who have run afoul of the regulators, so you're an investment advisor or a stockbroker, or you're taking commission from a financial firm, if for whatever reason the regulators strip you of that license, you can always go and get your insurance license. Those two individuals, those agencies do not talk to each other. So that's why I'd put last stop insurance license. So if I'm a bad actor in the financial services industry and I've been stripped of my ability to get commissions on securities, I can try to gravitate towards the insurance side. And again, it's something to be incredibly aware of. And I'm hoping that the regulators are going to figure this out. And we had talked about this, verify through regulatory reports. The golden nugget, the guidance that I gave you is pull those reports down first and then interview afterwards. Because then again, that gives you that information and that knowledge base to thoroughly understand if that individual is not telling you the truth. How will I pay for your services? This is probably one of the least understood avenues from the investing public in terms of how we get paid. So are you getting paid by commission? Are you getting paid by fee? Or is it a combination of both? And if you're dealing with an advisor who charges fees and commissions, so let's say that they're investing on your behalf and they're charging you an assets under management or a flat fee or something of that element, and they go out and they buy you an annuity or a long-term care policy or something like that, they're not only making money on the advisory fees, but they're also making money on the commission side. And time again, I see this. And when I talk to folks, I'm like, that's almost like double dipping, that the advisor's relationship, because they happen to be good, let's say at sales, they're getting money from you on the fee side, but they're also getting commission on the other side. And what I gently guide those people towards is ask them if they'll offset the fees that they're charging you for commission. So for instance, let's say that an advisor is charging you fees, assets under management, and they make $4,000 a year in terms of asset under management fees. And then they turn around and they sell you an annuity and they make $4,000 on an annuity. What you have to understand is that, are you getting $8,000 per year of advice? That's the critical element to it, is just to understand how that advisor is getting compensated, how much they're getting compensated, and is that worth the amount of money that they're giving you? So if it's an insurance sale, this is really, really important. And I see this time and time again. If I'm selling you an annuity, if I'm an insurance agent and you're being sold an annuity, that individual is going to earn a commission. And there's a wide range of commissions on different products. One of the questions you want to ask is, even though I'm not, paying you directly, the company is paying you your commission, will you provide me how much you receive in gross commission? Gross commission is important because that means how much the firm is getting. Because as you can imagine, everyone takes a little piece of that pie before it gets down to that individual insurance agent. And if the individual is like, don't worry about it, you're not paying that money, you're not paying us that money, the insurance agency is paying that money or the insurance company is paying that money, that's irrelevant. You want to understand, am I getting the value of what you're being compensated for? So you sit down and let's say you're seeking a financial plan. And I see this oftentimes in the insurance industry where they promise a financial plan and they give you a 1 or 2 page document that has a couple of pieces of information on it. And oh, by the way, an annuity will sell all your problems. And you take, let's say, $100,000 of your life savings and you give them that money for an annuity and they make $6,000 or $8,000 in commission. Did you get $6,000 or $8,000 of advice? And that's the goal, is to understand what value are you receiving for what they're receiving in compensation. Again, this is not any kind of good, bad, or indifferent. It's just to become an informed consumer in terms of how people get paid. Next, how will we work together? So am I going to be directly working with you, or is there a team that I'm going to be working with? When we sit down in our regular meetings, I'm going to assume I'm going to work with you, but the day-to-day elements, am I working with someone else? I've seen at times in different kind of groups and organizations where you meet with the lead advisor once and you get kind of tossed aside to some junior advisor from that standpoint. You want to understand who's going to be primarily responsible for your relationship, and then how are they going to service you in the future? Is this a one-time meeting, or are we going to have regularly scheduled meetings? And that's critical as well, because we all know, life changes and life can change pretty quickly, and so can your goals. So if it's a one-time transaction, you want to know that. Or are you going to be there if I have further questions? And what's important is that last line, will you be calling me just to solicit additional products? You're not going to get somebody who's going to say that. They're not going to come out and say, well, I've sold you this product today, and the next time I'm going to call you, I'm going to have to sell you something else. They're not going to tell you that. But what's important is, and I've seen this time and time and time again, is that we've sold you one thing and you go in for a review, let's say 6 months or a year, and now they're trying to sell you on another product. That is a sales relationship, not an advice relationship. So again, you want to have your eyes wide open before you start handing over money or checks from that standpoint. So can I have all of this in writing? This is where it gets fun. So these questions that I have and that I've laid out for you, you should be able to get these back in writing. If you're dealing with a very large firm, a major full service brokerage firm, it is unlikely that you're going to get a lot of this in writing. What you're going to get in writing is their 30 to 50 page disclosure document that you have to read through, put your legal reading glasses on, and go through all the different minute detail that you're going to have directly a very difficult time understanding who gets what and how. And that's how our industry and our regulators have determined the best way for you to become an informed consumer is by literally burying you in paperwork. So those on this presentation may have received prospectuses and other things, which you start reading through, and it's great reading material at night because it puts you to sleep almost immediately. So a lot of these questions aren't necessarily contained in those disclosure documents. So getting those in writing is a good idea. So as I had mentioned, the regulators are getting better. So instead of being the Wild West from 30 years ago, they're getting better at trying to help consumers understand the relationship. There's a new form that just came out, which is called Form CRS. And if you have a brokerage relationship, if you have a relationship with a securities firm, you most likely receive this form, which again is very detailed in regards to a lot of the legalese, but the first page gives you a general idea in terms of costs, fees, and expenses. If you're dealing with somebody like myself, who's an investment advisor, you should be getting on a regular basis what's known as Form ADV Part 2A and Part 2B and potentially Part 3. That again is a narrative on how we do business, where our conflicts of interest lie, and how much you're being paid or how much you're being charged for certain services. So there's a lot of information to sort of vet through in addition to these 10 questions that we've been given. So now let's go back to commission versus fee. So as a reminder, commissions are product driven. That again, I don't get paid unless I sell you a product. 96% of all insurance sales are commission based. Now, I have spent a lot of my career trying to find good fee-only products for our clients, and they're just starting to emerge today. The insurance company is figuring out, through the help of the public who is becoming much more informed, that, hey, commissions aren't necessarily bad. There just might be a better way of providing a good product or a good solution for an individual. But currently today, 96% of all insurance sales is commission driven. Now, those who are receiving commissions get upfront commissions and or trails. So what I mean by that is I can receive as a broker, let's say, a lower upfront commission. So instead of receiving 4% commission first time, only payment up, just one time, I can have a negotiation with the insurance company that I get a 1% commission and then let's say a 0.5% thereafter forever. Even though I have no obligation to you over the long run, as long as you keep that money in the product, I get paid. One of the things that our industry has been subject to, or what individuals have been subject to, is something called churning and switches. So on the security side, let's say mutual funds that have paid a commission, that churning and stock churning and things like that is kind of difficult to do today because the regulators have really focused in on it. But where this occurs generally is on the insurance side and annuities. So go figure, you buy an annuity, and over 5 years, you have the ability to take that out without any penalties or fees. And the advisor's like, hey, you know what? We can go put this into another annuity because this company happens to be, let's say, paying more money. And so oftentimes where we're seeing this churning or switches is in the insurance industry. When we're dealing with life insurance, and again, this is something I deal with and I see from time to time, is multiple policies. So insurance agents or advisors who are dealing in commission only, what I see is an individual has 2, 3, 4 life insurance policies. And my question is, why? When we're doing the financial plans for individuals, why do you have 3 policies? Well, the individual called and said it would be good to update and get another policy. And I'm like, well, that's not necessarily in your best interest. You should have got just a one-time bigger policy. And the reason is that there's a lot of pressure on these professionals to keep their sales going. And so one of the ways to do that is to sell you a policy and then call you years later and say, hey, you know what? Anything changed in your life? And you're like, yes, this happened, this happened. They're like, oh, well, you need additional insurance. And they go ahead and they sell you another policy. Again, just be very aware of the sales aspect to this. We've talked about on the commission side, it's a lower standard. It's a lower legal obligation to you. It's suitability and Reg BI. And again, it's opaque, especially when you're dealing in the insurance world and even in the securities world, you don't necessarily see how much you're paying and who gets paid what. Contrast that to the fee side. This is advice driven. We're giving you advice. We get paid for either giving you advice on your portfolio or financial plans, and there's no commissions if you're fee only. And it's asset based or flat hourly fees or a flat fee. And there's no transactions based. So it doesn't matter if you're paying your advisor a fee, if they buy or sell a security once or 10 times, they're not getting further compensation by churning, if you would, your portfolio. They just make a flat fee. They're also legally obligated to uphold the fiduciary standard, which again, we talked about that. That is the highest standard in the industry, the highest legal obligation. And that relationship is very transparent. You can see very clearly how much you're being charged, how much has been taken out, or what check you've written. It's very, very transparent from that standpoint. So we're going to go through this. We got about 4 minutes left. So we're going to try to get through this pretty quickly. So Insurance 101. So annuities are one of the largest products sold in the insurance industry, $220 billion of sales. And go figure, 75% of those sales have been in the highest commission products. So that is, I don't want to say appalling to me, but it's difficult for me to conceive that 75% of those products were the right, perfect, best solution for an individual. Here's another golden nugget, and this is really important. When you buy an annuity, you have what's known, typically you'll have what's known as a surrender charge. And what that means is that you give your check to the insurance company, they give you an annuity. In all the disclosure material, you're going to see a surrender charge schedule. And what that is and what that means is that you give the insurance company a check, you get an annuity, the insurance company gives the insurance agent a check. And so you've got to figure out that if you all of a sudden terminate that annuity sooner than later, the insurance company isn't going to be like, well, that's okay because, we paid the agent, they did their job, but we'll take the loss in terms of what we paid that insurance agent in terms of commission. No, they'll take that money directly out of your policy to compensate them for the commission that they paid the advisor. The higher the surrender charge, the more the commission the insurance agent made. So there's this absolute parallel that if you have a product, if you have an annuity, whether it's a fixed annuity, variable annuity, or index annuity, and that annuity has let's say a 10-year surrender charge, you can guess that agent, that person who sold you the policy, got a pretty high commission payment. Again, it's not good, bad, or indifferent. Just be very aware of that. So typically the commissions on, let's say, an annuity are between 2 and 8%. And so I can get a commission, and we talked about plus trails. So I might take that 2% commission up front. So it's $100,000 you put in an annuity. I get I get $2,000 in terms of what my commission is. And then I have a trail, which is a small ongoing commission that, let's say it's a 0.5%. So 0.5% on 100,000, I'll get every year as long as you hold that policy. So the insurance industry has figured out that if you're an individual who's solely motivated by upfront commissions, you're most likely going to try to sell that client on another annuity further down the road. But if the insurance company can give you that carrot, that teaser that says, hey, we'll keep paying you over time, more so than likely you're going to keep that product and suggest that person to keep that product should you check in with them. We talked about the new best interest rule in terms of Reg BI for the securities industry. There are efforts underway to have a best interest rule for annuity sales, and there's only 2 states that have who have taken that on, which is Arizona and Iowa. There's a couple of other states that have taken it. This is nowhere near where, again, I think the insurance industry should be. So while the regulators are working hard at this, you can understand that the insurance lobby, through their thousands and millions of dollars, are paying politicians to not adopt these rules. It's just too big of an industry to have their sales curbed. Behavioral Finance 101, greed versus fear. Those of you remember March of last year when the stock market just absolutely collapsed 30 some odd percent. Invariably, and I'm very attuned to this, literally once the market started to go down and once the calamity happened, I started to see a preponderance of annuity sales and annuity ads and safety and security. And the reason is when things get very volatile in the stock market, the insurance company pounces on your fear factor in regards to, wow, are you nervous about your portfolio? Give your money to us and we'll create stability. So conversely, on the other side today, the stock market is at historic highs. So firms are telling you, oh, look at all this money we're making. And so come on in and we'll make you lots and lots of money. That's the greed factor. So be very aware in terms of your own behavioral psychology in regards to greed and fear, and don't be swayed to a product sale based upon that. So the fiduciary and switching hats on annuity sales. So I had mentioned a firm that was on TV, and the first half of the program, they were talking about being a fiduciary and this is what we do and so on and so forth. And the back half of the program was about fixed annuity sales, fixed index annuity sales. I had a good idea in terms of what they were doing, which was hat switching. You walk into the firm and you talk to the individual about managing money in their portfolios. They've got the fiduciary hat on because that's a fee relationship. Oh, by the way, go talk to my associate. You go talk to the associate, the hat comes off, and now they're an insurance salesman. So be very careful about hat switching in regards to making sure that that individual has your best interest at heart. Oh, we're over. Be wary of buying what you can afford versus what you need. That's important. So insurance people will shoehorn in, they'll ask you, well, how much can you pay? And go figure you'll get a policy that will fit right into that. And then again, you're entitled to know what commission is earned. That's really important. So if there's a commission that is being paid, you're entitled to know what it is. So quickly, investments 101, whether it's stocks, real estate trust, private equities. So these are some of the top Finra complaints, and Finra is the regulator. So when individuals don't like how a product was sold, they can go complain to the regulators. And these are the areas that are towards the top. The industry by far is a relatively good industry. There's only 763 people that were barred out of over 600,000 individuals. So what that means is that there's a lot of people doing good work. But again, you want to make sure you're vetting that individual, that professional, that they have your best interest at heart. So again, understanding the total expense of the relationship is really important. What does it cost? Are you making fees and commissions, and how much is the total compensation versus the value you're getting for that relationship? Custody of assets is really important. Generally, most advisors hold their assets with a third-party custodian. Names you've heard, Fidelity and Schwab and TD Ameritrade, they don't hold their assets on their own and they don't have custody. It's important to understand that if they do, you need to ask more questions because they have the ability to use that money wherever they want to. Bernie Madoff is an example where Bernie Madoff took clients' monies, some of it went into investments, and some of them went into his Park Avenue apartment fund to help support his lifestyle. Beware of glossy brochures. high historical returns, and slick sales presentations. If you're feeling that, it's almost like a used car sort of relationship. Just again, understand and know, keep that behavioral finance, face on. Don't get swayed by greed or fear. High potential for costly commission and fee relationship. We talked about that. If your advisor is earning fees and commissions, it could be costing you a lot more than you realize. So wrap up. Start with your goals. Your goals drive the product or the solution or the advice that you're searching with. Start with you. It's not how much can my portfolio make for my lifestyle. It's what do I need and what am I trying to accomplish, and what are the appropriate or best products or solutions for that. Commissions versus fees. It's your money. It's your goal. And again, this is not a bad thing about commissions or fees. This is just the nature of our industry. What you really want to focus on is the nature of the professional you're dealing with. Is that individual, approaching you in a fiduciary way? Is that individual an upstanding person in terms of making sure that the solutions that they're offering are a great fit for you, not just an okay fit, but the best fit for you? Transparency is key. Compensation and cost. What is it costing you? What is the individual being compensated and how much? And is that meeting your needs? Trust but verify. Regulatory background checks. If there's someone you're working with today or some people you're vetting in the future, please verify them through the different regulatory agencies to ensure that what they're telling you is authentic and true. Legal obligations. Understand that what is their legal obligation to you? Is it a legal fiduciary obligation? Is it under Reg BI, or is it just suitability? Those of you who might be looking at vetting an advisor or a financial professional to work with, 3 is a magic number. What I mean by that is this is your life savings. So talk to at least 3 different advisors. And while it may seem a lot of work to go through and vet all these folks properly, it's critically important because, again, bad advice can cost you not only today, but can cost you dearly into the future. Here's a whole bunch of resources. And again, this is why I had mentioned in the very beginning that we'll provide this with Jill. There's a whole bunch of resources in regards to understanding professional relationships. The 2 main ones that I've outlined to you, which is Finra through BrokerCheck and the SEC through their advisor portal, are great ways to start. Okay, I know I kind of rushed through the end, trying to be very sensitive to folks' time. But from my standpoint, I want to thank you for taking time out of your busy day to engage with us and to provide you, hopefully, 2, maybe 3 nuggets of information that you might not have had before. Or again, if everything that I just went through, you're like, hey, I know this, then terrific. Then I've reinforced your knowledge in regards to the professionals that you're dealing with. So again, thank you very much. And Jill, if there's any questions, we'd be more than happy to take them. Jill?
Yeah. Hello?
Oh, there we go.
Yeah.
There we go. So there's a Q&A button, or I don't think there's a chat, but no open questions.
There's
so here's the challenging part about these presentations is when we're one-on-one, when we're live in a non-COVID environment, I have a good feeling for the energy of the room. And I try to guide individuals on questions. And what I found is once one person asks a question, then I get a whole slew of questions. But there's people don't want to be the first one. So if there's any questions that you have, anything that you need clarification on, we'll be on for a couple more minutes. Please just put in, a question. It's on the bottom of your, right? Typically
Someone
on Zoom.
is asking about a mailing list, or do you have a mailing list or e-newsletter? And also, what about small group investment club?
Excellent. So we have Engage Wealth is on the internet. So we put postings up from time to time. A lot of the times the complement when we're asked to be on the radio for WBBM, we'll complement that topic. And that's typically, the best place to go in terms of information from us in terms of the website. We do a lot of these presentations. So we're going to, working through local libraries as well. So we're kind of around a lot. So that answers that question. In regards to investment clubs, so investment clubs had their heyday, if you can imagine, in the late 90s with the internet bubble. And the number of investment clubs just dropped precipitously. Investment clubs, in my idea, is a great idea because it helps you not only stay informed, but generate ideas in regards to different investments. Typically, the capital contribution, how much money you're putting into the club, is not a significant portion of your portfolio. So I'm a big fan of sitting around and sharing ideas in regards to, hey, what do you think about this investment? What do you think about that investment? And don't forget, an excellent resource in terms of vetting different investments is through the library. The library has a lot of free resources that you can use, Morningstar and others, to help you with your own investment decision making in terms of getting that information. So that's a great, at least to me, if it's working for you, I love communities when we're talking about different investment ideas. What?
We saw that. Okay.
Yep. So Jill is going to have PDFs of the presentation. I'm going to send it to her. And so I don't have, just so you all know, I don't have your emails, and that's by design. There's this wall between you as a patron and the library, and that's by design. So Jill has your email. So I will provide Jill the PDF, and then she can send those out. What is a Series 65 from Ozzy? A Series 65 is a license that I have as an individual advisor that allows me to take fees. So as a Series 65, I have an ability to take fees. If I had a different license, let's say a Series 7 license, I could only take commission. If I have a Series 7 and a 65, I can take fees and commissions. Oh, this is great. Okay, so Chuck, I'm going to get to yours in a second. David, what is a common fee for an advisor? Excellent question. And this is a huge range. I've seen fees as high as 2%, and I've seen fees as low as 0.25% or 0.25%. The important part is if you're just seeking or if you're just receiving investment advice. And what I mean by that is you've handed your money to a professional and they're just investing your assets. Those fees should be on the lower end of the spectrum because all they're doing is providing you just investment advice. In our firm and several other firms who are CFPs, you're not only getting that investment advice, but you're getting that comprehensive advice as well, where they're helping you with your taxes, your estate plan, your goals, and things like that. And paying a higher fee to get that value makes sense. Okay. Chuck, state, own a farm in a different state, receive retirement pension for the state. Now I live in Illinois, have investments, private, seek a financial provider, but it doesn't matter what state. No, I can tell you one of the challenge. I mean, COVID has been horrible, right? It's been just an absolute scourge on on the planet, basically. But what it basically has done, because a lot of folks are new to Zoom and been doing this kind of thing, we have clients all over the country. And so while we've been on Zoom forever and have desktop and virtual meetings forever, it's relatively new to the industry. So you don't specifically need an advisor in that state. You just want an advisor who knows and understands, because just in the short sentences you wrote, you've got some estate planning issues or concerns or things that you're going to need to put in place when you have property outside of the state. I'll just kind of leave it there, but you don't necessarily have to have an advisor in the state here. Like I said, I've got clients all over the country. And again, this kind of interaction is very helpful. Is there more that I'm missing? Yes, Barbara, there will be a recording. So I had asked for that in particular to your question. Yes, there will be a recording of the presentation. Okay. I'm still open for questions if you want to type. There's 6. Open. Answer live. Did that. Okay. If there's no further questions, I'll speak slowly in case people are typing slowly. Again, I want to thank you. I want to thank the Winnetka-Northfield Public Library for this opportunity to present. Um, Education and financial literacy is a deep passion of mine. I've often heard that there's not enough financial literacy out there in the world. And the answer is we're drowning in financial literacy. There is so much information out there. Oftentimes we get information overload. What we need to do better as a profession is to connect that financial literacy with action and understanding. I often like the analogy that if it's financial health or physical health, I know on the physical health side, I need to exercise and eat well. But yet the United States is said to have an obesity problem. I think we all know what to do. It's just not easy to do the things we're supposed to do. So conversely, on the financial health side, we all know if we spend less, invest more, save more, being good stewards of our money, that financially we should improve, yet oftentimes we don't do those things. So, from our standpoint, it's a non-judge zone. We don't judge people. We just try to give them the guidance necessary. And that's why these kind of interactions are so important for me, is because of the fact that we're providing information that is tangible and that after this presentation, you can actually use, again, whether you're vetting somebody or you're currently working with somebody, to be able to have actionable items. And that's, again, where those golden nuggets come from.
Could I ask one question about the one-on-one at the library?
Sure.
Do you want me to talk about it, or you want to talk about it?
Yeah, we've got two more. Well, thank you, David. Thank you. But Chuck asked the question, how important to have an umbrella insurance policy? This is a specific one-on-one. And if you're working with a financial planner, a CFP, or a financial advisor, they should be able to direct you with that. Depending on your situation, I happen to be a pretty big fan of umbrella policies, but again, it all depends on your specific situation. So Jill, go ahead, talk about the one-on-ones.
Yes, we have a one-on-one appointment the second Tuesday of every month. You can sign up through our website, and it's 1 hour only, but right now they're pretty wide open and you can sign up.
So just to kind of expound a little bit on that, Jill.
Thank you.
I've been doing financial community outreach, again, like I said, for almost 15 years here in local area libraries. And so again, it's a privilege for me to be invited by the Winnetka-Northfield Library to offer one-on-one financial planning where you can sign up for a free, no obligation. This isn't a sales presentation where, Chuck, if you've got a question like that in terms of your umbrella, you have a free hour with me. Now, my rates are $300 an hour. So this is a high value, especially given my experience. And so the library is offering those slots, which you had mentioned the second Tuesday of the month. You just need to reach out to Jill and or the website, I think, and you can sign up for a slot. So currently it's 1 slot per month. And we've got some open slots down the road. And from an interaction standpoint, this is how we interact currently under COVID. It's a Zoom session, and again, it's just come with any questions you have, and we'll give you the best guidance as we can without being too specific in terms of we don't tell you what stocks to buy or what mutual funds to buy. That's not what this is about. It's giving you comprehensive, some high-level comprehensive financial planning guidance to help answer some immediate questions you may have. I think we're good.
Yeah, I don't see anything else.
Okay, applause. So thank you so much, everyone, for being on the presentation today. You have a great day, and I hope all of you enjoy your weekends coming up, and be healthy and be safe. So thank you.
Thank you.